Hello everyone. Today we continue the second module topic again. Very important topic it is also. That's estimation of ownership cost. Purely these are all the costs which are related to the equipment. So by investment made on the equipment, the owner is losing an amount equal to the interest or return one would have otherwise received from the bank or other sources of investment. So if I want to hire any equipment, so I want to invest the amount into the equipment. So the same amount if I keep in the banks, I will get some interest. So always when I invest some money into the equipment, then always I have a chance to lose some interest or returns. So for those purpose of calculating the total cost of the investment, the interest, the taxes, insurance, etc. may be taken as the cost of equipment. So ownership costs are fixed costs. These are all nothing but your fixed costs. Almost all of these costs are annual in nature. So it is calculated for annual. So and the very important uh, costs that will come under this ownership cost are initial capital cost, depreciation, and investment cost, that is interest cost, and the last one is insurance cost and taxes and storage cost. So let us go one by one. First one is initial capital cost. What is it actually? On an average, initial cost makes up about 25% of the total cost invested during the equipment's useful life. This cost is incurred for getting equipment into the contractor's yard or construction site and having the equipment ready for operation. Many kinds of operations, ownership and operating costs are calculated using initial cost as a basis, and normally this cost can be calculated accurately. So it is the purchasing cost. When you go for purchasing the equipment, what is actually the cost? What are the things it includes? That is actually initial cost consists of following items. So initial cost, when you have to calculate, the following items are added to get the initial cost of that equipment. That is price at the factory during the what you call the price at factory plus extra equipment. If for one equipment you need some other extra equipment, so the extra equipment for that cost also you have to include, plus sales tax. That is the first cost. And next one is cost of shipping, so from the factory site to the your required site. So it is your cost of shipping and cost of assembly and erection. That is some of the equipment you have to assemble in the site itself, so it also includes the cost. So these three main important costs group together to form initial capital cost. So second one is depreciation. Depreciation is nothing but as year passes, the actual amount of the equipment start reducing. That is, if we buy a new car and after 1 year, if we want to sell it, so always the amount what actually we have to sell, it is always lesser than that what actually we have bought, what actually the cost we have bought it. So depreciation represents the decline in the market value of a piece of equipment due to age, wear and deterioration and obsolescence. So depreciation can result from physical deterioration occurring from wear and tear of the machine after the usage. Next, economic decline, obsolescence occurring over the passage of time. So in the appraisal of depreciations, some factors are explicit while other factors have to be estimated. So when you have to go for a depreciation calculation, these 3 points has to be focused very deep. That is, first one is initial cost. What is that? The amount needed to acquire the equipment. So initial cost, as we have discussed in the previous slide itself, that is nothing but your initial cost. Next, useful life. That is another factor to be considered. That is number of years it is expected to be utility value. Is of utility value. How many years I used it. So that is your useful life. Next, salvage value, the expected amount the asset will be sold at the end of its useful life. So if you want to sell that equipment today, uh, till today, what is actually the amount, how much actually the amount I can spend it for. So it's like, for example, if I take a car worth of 10 lakhs rupees, and salvage value is nothing but after 10 years, I'm selling this to some very minimum amount. Below that, it cannot be sold. Below that, it cannot be sold out. So maybe around 6 lakhs after 5 years, if I consider, if it is 6 lakhs, then that is your 6 lakh is your salvage value, whereas 10 lakh is actually your initial cost, whereas a useful life is 5 years. That is the example. So how to find out this depreciation? So there are methods. There are very important 4 methods. Generally, they were using to find out the depreciation rate. First one is straight line method of depreciation. Second one is declining balance method of depreciation. Third one is sum of the year's digits method of depreciation. And last one is sinking fund method of depreciation. So we'll go one by one. First one is straight line method of depreciation. So what actually done in this straight line depreciation is the simplest to understand, as it makes the basic assumption that the equipment will lose a same amount of value in every year of its useful life until it reaches it with its salvage value. So for every year, a constant amount has to be decreased from its initial cost. So that is your depreciation, that is straight line method of depreciation. Let P is equal to first cost of asset, in the sense when you purchase the equipment, what is that amount actually, that is your P. Whereas F is the last cost, end cost of the equipment, that is salvage value of the asset. Next N is life of the asset. BT represents book value of the asset at the end of the period T1, and DT represents depreciation amount, and depreciation is given by this equation, very simple. DT is equal to P minus F divided by N, where P is initial cost, F is salvage, divided by N. N represents the life number, and that is life of the asset is in terms of years. Whereas BT is nothing but book value. Book value is equal to BT minus 1, in the sense if I want to find out the book value during 10 year, so I want to consider the book value of 9 year minus DT is nothing but depreciation amount for the period T. So this will be easily understood when we solve some problems based on this. So we'll go for second one, that is declining balance method of depreciation. Whereas in straight line method, a constant amount is declined every year, whereas in declining balance method, a constant percentage of book value of the previous period of the asset will be charged as the depreciation amount for the current period. So there a fixed amount is decreased or declined. Here a constant percentage is declined. This approach is more realistic approach, since the depreciation charge decreases with the life of the asset, which matches with the earning potential of the asset. So as the year decreases, the constant percentage rate also start decreasing. The book value at the end of life of the asset may not be exactly equal to the salvage value. This is actually its drawback. So let P is the first cost of the asset, F is the salvage value, and N is the life of the asset. BT again book value of the asset at the end of the period T, where K is nothing but a fixed percentage, and DT represents depreciation amount. Then DT is equal to K into BT minus 1, where K is a fixed percentage, T minus 1 is the book value of the asset at the at previous year of the um, previous time. Next, BT is equal to BT1 minus DT. While availing income tax expectations for the depreciation amount paid in each year, the rate K is limited to the most 2 by n. So it is called double declining method, a double declining balance method, where n is replaced by 2 by n. So we'll move to third method, that is sum of the year's digits method of depreciation. This method tries to model depreciation assuming that it is not a straight line, whereas in previous things there is a constant amount is declined in the first method, whereas a constant percentage is declined in the second method. So the graph we will get is a straight line, whereas in some of the years digits method it is not a straight line. The actual market value of the piece of equipment after 1 year is less than the amount predicted by the straight line method. So the actual market value of the piece of equipment after 1 is less than the amount what actually you have obtained from the straight line method. So in this method of depreciation, it is assumed that the book value of the asset decreases at a decreasing rate. Whereas in a declining balance method, there is decreases at fixed rate, whereas here decreases at decreasing rate. If the asset has a life of 10 years, the first sum of the year is computed as. So sum of the year is computed as, if it is 10 years, then 1 plus 2 plus 3 plus 4 plus total it is 55. The rate of depreciation charges for the first year is assumed as the highest and then it decreases. That is, the rates of depreciation, if for first year, then it will be 10 divided by 55. For second year, it is 9 divided by 55. For third, it is 8 divided by 55. So at the last, it becomes 1 divided by 55. So after calculation of this, so again, P is the first cost and F is salvage value, N is life, BT is book value, depreciation DT. So DT is equal to rate into P minus F. So depreciation rate at year T is given by rate. Already you have calculated. If it is first year, then for the above example, it is 10 by 55. That is your rate into P minus F. So if it is second year, then it is 9 by 55 into P minus F. So BT is BT minus 1 divided minus DT. So fourth one is sinking fund method of depreciation. In sinking fund, if a structure has a if a equipment has a lifespan of 10 years, so for every year a fixed deposit is a fixed amount is deposited. So at the end of the 10th year you will get some amount, so that should be equal to the rate at which you have already bought the at the beginning itself you have got the equipment at that rate. At the end of that you have to get the same amount. So in this method it is assumed that money is deposited in sinking fund over the useful life that will be enabled to replace the asset at the end of its useful life. For this purpose, a fixed amount is set aside every year from the revenue generated, and this fixed sum is considered to earn interest at an interest rate compounded annually over the useful life of the asset, so that the total amount accumulated at the end of the useful life is equal to the total depreciation amount. How much it is actually depreciated, that much amount you have to get at the end. The annual depreciation in any year has two components. So first one is fixed sum that is deposited into the sinking fund, and the second component is the interest earned on the amount accumulated in the sinking fund till the end of that year. So always it has two components. One is how much amount you have fixed, you have put it into the sinking fund, and what is actually the interest you will get for that sinking fund. So these are the two components. So how to calculate it? For this purpose, first the uniform depreciation amount at the end of each year is calculated by multiplying the total depreciation amount over the useful life by sinking fund factor. After that, the interest earned on the accumulated amount is calculated. So the first component of the depreciation, that is uniform depreciation amount A, at the end of the year is given by A is equal to P minus F into I divided by 1 plus I to the power N minus 1, where P is equal to first cost of the asset, F is the salvage value, N is life of the asset, whereas I is rate of return compounded annually. For that much of sinking fund, how much rate of return I will get, that is your I. Next, depreciation amount for first year is equal to A, as this is the amount to be deposited in sinking fund at the end of the first year, and hence there is no interest. So for the first year there is no interest, you have just added into the sinking fund. From the second year you will get the interest. So for the first year you will get a D1, that is depreciated amount is equal to A, that is A into 1 plus I to the power naught. Now book value at the end of the year is given as B1 is equal to P minus D1, whereas D1 is already given a into p minus a into 1 plus I to the power naught. Similarly, depreciation for the second year, that is a plus d1 into I, d2, that is d2 is equal to a plus d1 is always given as a into I, that is a into 1 plus I. Book value again b1 minus d2. So similarly, third year is also again becomes a d3, whereas b3 it comes for book value. Similarly, we will calculate the sinking fund for the expected years. So these two we completed. First one is initial cost, initial capital cost. Second one is depreciation and different methods to calculate the depreciation. Now third one is investment or interest cost. What it is actually? It represents the annual cost of the capital invested in a machine. So if borrowed funds are utilized for purchasing a piece of equipment, the equipment cost is simply the interest charged on these funds. However, if the equipment is purchased with the company assets, in interest rate that is equal to the rate of return on the company investment should be charged. So therefore, it is computed as product of interest rate multiplied by the value of the equipment, which is then converted into cost per hour of operation. So C is equal to P into N plus 1 divided by 2, where P is the initial cost, C is the average value, N is the useful life. If equipment has a salvage value, then your F comes into picture, where F is your salvage value. That is C is equal to P into N plus 1 plus F into N minus 1 whole divided by 2 into N. Next, insurance, tax and storage costs. So insurance cost represents the cost incurred due to fire, theft, accident and liability insurance for the equipment. If something happens, the insurance cost also has to be conquered. Next, tax cost represents the cost of property tax and license for the equipment. Whereas the storage cost includes the cost of rent and maintenance for equipment storage yards, the wages of guards and employees involved in moving equipments in and out of the storage and associated direct overhead. So the cost of insurance and tax for each item of equipment may be known on an annual basis. So always this cost, again insurance, taxes and everything we will calculate it for annual, on the basis of annual. So in this case, this cost is simply divided by the hours of operation during the year to yield the cost per hour for these items. So finally, total ownership cost is nothing but the sum of depreciation cost, investment cost, insurance cost, tax and storage cost. If you add these four, finally you will get total ownership cost.